What if I told you one company owns pieces of Apple, Microsoft, Amazon, Coca-Cola, and nearly every major corporation in America? It doesn't build cars, it doesn't sell phones, it doesn't drill oil, but it controls trillions of dollars, and most people have never heard of it. This is the rise of BlackRock. In 1988, a group of Wall Street executives led by Larry Fink founded a small bond investment firm under the umbrella of BlackRock. Their mission was simple: manage risk better than anyone else. Fink had learned a brutal lesson earlier in his career after losing nearly $100 million on a bad bond bet. He became obsessed with risk control. That obsession would become the foundation of an empire. At the core of BlackRock is not a skyscraper, it's software, a risk management platform known as Aladdin. Aladdin analyzes trillions of dollars in assets, stress tests portfolios, and models market shocks. It doesn't just manage BlackRock's money. Banks, pension funds, and governments use it too. In modern finance, data is power. BlackRock doesn't just manage capital, it maps the system. Then came the shift that changed everything: passive investing. Instead of trying to beat the market, BlackRock embraced index funds and ETFs. Through its iShares division, it allowed ordinary investors to buy the entire market in one trade. As money flowed into passive funds, BlackRock's assets exploded. Trillions poured in, and with every dollar invested, BlackRock gained voting rights in the companies it owned. It didn't own companies in the traditional sense, but it owned influence. When the 2008 financial crisis hit, Wall Street trembled. Banks collapsed, markets froze, and the US government needed help valuing toxic mortgage assets. They turned to BlackRock. While firms like Lehman Brothers disappeared, BlackRock advised the Federal Reserve. The crisis didn't shrink BlackRock, it expanded its role, from asset manager to system partner. Today, BlackRock manages more money than the GDP of most nations. It holds stakes in Apple, Microsoft, JP Morgan, ExxonMobil, not because it wants control, but because it tracks the index. This is the paradox of passive investing. The more neutral it becomes, the more powerful it grows. When one firm becomes the largest shareholder in thousands of companies, governance changes, capital becomes centralized, and influence compounds quietly. BlackRock has been criticized from multiple angles. Some say it pushes corporate activism through ESG policies. Others say it represents dangerous financial concentration. But BlackRock argues it is simply managing money on behalf of teachers, firefighters, and retirees. It doesn't own the money, it allocates it. Still, in a system built on scale, allocation is power. BlackRock is not an accident. It is a product of our financial architecture: low-cost indexing, retirement accounts, 401k systems, global capital flows. When millions of Americans invest passively through retirement funds, those funds are concentrated in the largest asset managers. Efficiency creates giants. Giants reshape markets. BlackRock didn't conquer the world with armies, it did it with allocation. In the age of debt, capital doesn't just build companies, it builds systems. And the firms that map the system eventually guide it. The rise of BlackRock is not just the story of one company, it's the story of modern capitalism concentrating itself. Because in our era, power no longer wears a crown, it holds shares. And the real question is not who owns BlackRock. The real question is, who owns the system? This is the age of debt.